Okay. Okay. Hi. Morning, afternoon, evening to everybody. It depends on your time zone, but it's nice to have you here. So I would like to introduce you Edward Rubinsky. He's a qualified accountant and an IT professional. His interest is at the same level between finances and IT, and this led him to study blockchain, and he will share some knowledge with us through today's topic. Cryptocurrencies and taxation, the tax treatment of cryptocurrencies in selected countries. So thanks for being here with us. I will give the word to Edward.
Hello, everybody. As I said, my name is Edward Ravinsky. I work for EPAM in Switzerland. And the topic that I want to discuss with you is cryptocurrencies and taxation, the tax treatment of cryptocurrencies in selected countries. So without further ado, let's have a look at what we'll be talking about in a bit more detail. First, we'll discuss what are cryptocurrencies. Then we'll have a look at why do tax offices tax transactions with cryptocurrencies. Then we'll look at what are assets and why does that matter here in terms of this talk. Then we'll answer the philosophical question of what is money. Then we'll look at some tax treatments from different countries and jurisdictions. And then we will discuss what EPAM could do to add value through engineering in the market of cryptocurrency. And then we'll have a Q&A session. So, as said, my name is Edward Ravinsky. I'm a senior business analyst at EPAM Systems. I am at on the same time a qualified accountant and also an IT specialist. I've been working for many years in fields which cover both areas, specifically financial systems and accounting systems in major corporations, banks, in all sorts of countries all over the world. I studied both in parallel at university in Australia quite a few years ago by now. And I've always kept myself abreast of the topics. And blockchain is one of those things where it seems that the two just converge together, which is why I have such an interest in the topic. And I thought it would be interesting and useful to have a look at this topic because there are so many people that could be affected by it. So before we begin, I'm not going to read out the slide. Don't be afraid of that. But I just want to say there's no way that I'm going to be able to cover all of the information that would be needed to make a practical decision for the jurisdiction that you're in. If you happen to be covered in this talk, just use this as a guide to start thinking, where could you look, or what might be the potentials if you start looking in some of these jurisdictions as to whether you can trade or use cryptocurrencies for purchasing and things like that. Please do not base this as financial advice. So let's have a look at what actually are cryptocurrencies to begin with. According to Investopedia, cryptocurrency is a digital or virtual currency that is secured by cryptography, which makes it nearly impossible to counterfeit or double spend. And a defining feature of cryptocurrencies is that they are generally not issued by any central authority, rendering them theoretically immune to government interference or manipulation. In other words, cryptocurrencies are currencies which are not managed centrally. They're not issued by banks or other institutions. They are run in such a way that the trust is built up inherently inside them. And why do tax offices tax transactions with cryptocurrencies? Well, for one thing, cryptocurrencies have prices that are quoted in fiat currencies, mostly in US dollars, but it doesn't have to be just in US dollars. Purchasing goods and services are themselves taxable in many jurisdictions. So it's just the act of purchasing something itself creates a tax event. And taxing transactions made in cryptocurrencies is another source of income for governments. So what are assets and why does it matter here? An asset is defined as a resource with economic value that an individual, corporation, or country owns or controls with the expectation that it will provide a future benefit. And it means that a box of chalk is an asset, a car is an asset, clothes are assets, and cryptocurrencies. There it's not so clear. And that's what we'll discuss in a few minutes. But money, according to the definition, is an asset. But what is money? So money has three characteristics. at least according to the textbooks. It can be a medium of exchange, a measure of value, and a store of value. And ever since money has been decoupled from the gold standard, starting in 1971 in the United States of America, all world currencies have become fiat money, where fiat means by decree. Our money is money because the government says it is, and not because of any inherent value in the money itself, not because it's made from gold or silver or other precious metals, or because it can be exchanged one-to-one for gold, which is represented by that note or by that coin, but because the government says that it is money. So fiat money allows the international banking system to create debt and use it for bailouts and the like, which we have been witnessing since 2008's financial crisis. Although that was not actually the first time that anything like that has ever happened before. But fiat money is based on trust, and cryptocurrency is based on trust as well. With fiat money, the trust is based on government decree. And with cryptocurrencies, it is shown through proof of work, proof of space, etc. Proof of something. So the question boils down to, which would you trust more? Government decree or proof of work and the like? So the trick that goes on here in the background with taxation is, and it's simplifying things a little, if a person swaps a hamburger for a packet of chips, that's not taxable. If a person mows the lawn of the person who cut their hair, that's not taxable. As soon as money changes hands for the exchange of goods or services, it becomes taxable. Swapping cryptocurrencies for a good or service is deemed to be taxable by most taxation authorities, even though cryptocurrencies are not money in the technical sense. Governments can now tax barter transactions if the record of that barter transaction is kept in a peer-to-peer decentralized journal of transactions. So that's basically what's going on when countries declare that they want to tax cryptocurrencies. Now, having a look at the taxation treatments in Switzerland, we see that there's a wealth tax that is put upon it. Cryptocurrencies are perceived as cash or movable assets, which are subject to a wealth tax, and they must be listed in the Schedule of Securities and Assets in the Swiss tax returns. Capital gains tax is not taxed at all in Switzerland when it comes to cryptocurrency transactions. And when it comes to income tax, they are taxed only if a person is a professional trader. Otherwise, no income tax is payable, unless one's salary was paid in cryptocurrency. And the tax authorities of Switzerland care only about how much cryptocurrency you had at the end of the year, and their value in Swiss francs is equivalently. In the United Kingdom, individuals that hold crypto as a personal investment will be liable to pay capital gains tax when they dispose of their cryptocurrency. Disposal has been defined by Her Majesty's Revenue and Customs as selling crypto assets for money, exchanging crypto assets for a different type of crypto asset, using crypto assets to pay for goods or services, or giving away crypto assets to another person. The amount of capital gains will be the difference between the sales proceeds from the disposal and the acquisition cost of the crypto asset. That is the sales price minus the buying price. Now, the tax owed depends on one's tax bracket in the United Kingdom. If you're a higher or additional rate taxpayer, your capital gains tax rate will be 20%. If, on the other hand, you're a basic rate taxpayer, your tax rate will depend on your taxable income and the size of the gain, after any allowances are deducted. If you are carrying on a business that involves cryptocurrency transactions, then the rules get more complicated. You may be liable to pay several different taxes like capital gains tax, income tax, corporation tax, stamp duties, and even value-added tax, depending on the type of transaction. When it comes to mining, if your activity is classified as a hobby, then any income from mining must be declared separately under the heading of miscellaneous income on your tax return. The income in this case will be the fair market value of the crypto at the time you receive it. Appropriate expenses can be deducted from this income before adding it to the taxable income. Disposing of this mined cryptocurrency will be subject to capital gains tax in the UK. If your mining is classified as a business, Then the mining income will be added to trading profits and be subject to income tax. Similarly, fees or rewards received in exchange of any mining or staking activity will also be added to taxable income. Appropriate expenses would be deductible though. While disposing of such a cryptocurrency, any gain in value from the time of acquisition will be added to the trading profits. You will also have to pay national insurance contribution for this transaction. So what's the difference between those variants? So say you buy Bitcoin at 1,000 pounds on the 1st of January 2021. If you sell that Bitcoin at 2,000 pounds on the 31st of December 2021, you have deemed to have earned 1,000 pounds as income, which is taxed at the same rate as your salary, which can be up to 11.5% of income. However, if you sell them on the 1st of January 2022, you are deemed to have sold an asset and are taxed lower and differently. So when it comes to record keeping in the United Kingdom, the person who makes a transaction with cryptocurrencies has to record the following. There has to be the type of crypto asset that was traded or used, the date of the transaction, whether they were bought or sold, the number of units involved, the value of the transactions in pounds sterling at the date of the transaction, the cumulative total of the investment units held, and bank statements and wallet addresses in case these are needed for an inquiry or review by Her Majesty's Customs. Now, jumping to the Russian Federation. Legislation for the taxation of cryptocurrencies passed its first reading in the Duma, which is Russia's lower house of government, in January 2021. The bill proposes to recognize cryptocurrency as property for purposes of taxation and not as a currency. Traders have to register for value-added tax with the authorities if their trading exceeds 600,000 rubles, which is about 8,140 US dollars in any given calendar year. And the proposed value-added tax on cryptocurrencies is 20%. On the flip side, though, as a benefit for those who own cryptocurrency in the Russian Federation, courts will recognize legal rights for owners of cryptocurrencies within Russia as pertaining to property, which has not actually been the case to date. So owners of cryptocurrencies will get some benefits by the legislation coming through. And if a person does not register their holdings, there will be heavy penalties to be paid to the tax authorities, including retroactively. There are some limitations though. As said, although the new law will give legal status to cryptocurrencies as property, the proposal is to forbid the use of cryptocurrencies as a legal means of payment. In other words, in Russia, the Russian Federation will not allow transactions to be made using cryptocurrencies within the country. Failure to declare cryptocurrency transactions would result in a fine of 10% of the undeclared amount, and a penalty of 40% of the required amount of tax will be applied for a non-payment or incomplete payment of tax. Now, in Australia, a capital gains tax event occurs when you dispose of your cryptocurrency. A disposal can occur when you sell or gift cryptocurrency, trade or exchange cryptocurrency, including changing one cryptocurrency for another cryptocurrency, convert cryptocurrency to fiat currency, such as Australian dollars, or use cryptocurrency to obtain goods or services. If the disposal is part of a business that you carry on, the profits you make on disposal will be assessable as ordinary income and not as capital gain. While a digital wallet can contain different types of cryptocurrencies, each cryptocurrency is a separate cryptocurrency asset, a separate capital gains tax asset. And if you're carrying on a business that involves transacting with cryptocurrency, the trading stock rules apply rather than the capital gain tax rules. Not all people acquiring and disposing of cryptocurrency will be carrying on businesses. To be carrying on a business for the purposes of taxation of cryptocurrencies in Australia, you will usually carry on your activity for commercial reasons and in a commercially viable way. Undertake activities in a business-like manner. That would typically include preparing a business plan, acquiring capital assets or inventory in line with this business plan, preparing accounting records and market a business name or product, and intend to make a profit or genuinely believe you will make a profit, even if you are unlikely to do so in the short term. So here are some examples to differentiate between those scenarios. Sachin is in the business of trading cryptocurrency. On the 15th of December, 2017, he purchases 1,500 Bitcoins for 150,000 Australian dollars. On the same day, he sells 1,000 Bitcoin for 200,000 Australian dollars. If Sachin holds the cryptocurrency for sale or exchange in the ordinary course of his business, Sachin can claim a deduction for $150,000 for the Australian dollars for the acquisition of the Bitcoin and declares income of 200,000 Australian dollars for the later sale of the Bitcoin. On the other hand, Dora provides legal advice to Project ICO and receives 10,000 ICO tokens as consideration for her services. The money value of the 10,000 ICO tokens is ordinary income for Dora at the time that the tokens were derived. When Dora later sells her cryptocurrency, the cost of her tokens is their market value at the time she received them. In Australia, they make the distinction of personal use assets. Some capital gains or losses that arise from the disposal of a cryptocurrency that is a personal use asset may be disregarded. However, where the cryptocurrency is acquired and held for some time before any such transactions are made, or only a small proportion of the cryptocurrency acquired is used to make such transactions, it is less likely that the cryptocurrency is a personal use asset. In those situations, the cryptocurrency is more likely to be held for some other purpose. Only capital gains you make from personal use assets acquired for less than $10,000 are disregarded for capital gains tax purposes. However, all capital losses you make on personal use assets are disregarded. Selling of securities on the Australian Stock Exchange. In other words, if you make a transaction with a cryptocurrency of some kind, you have to record more information buying and selling. Oh, was it broken? Oh, broken. Sorry. Yeah. Can you see it again? Good. Thank you. So, sorry about that, ladies and gentlemen. So now we can jump to the United States of America. Oops, we're jumping through more than that. Now, in America, cryptocurrencies are classified as types of virtual currencies and taxation rulings. Virtual currency is treated as property, and general tax principles applicable to property transactions apply to transactions using virtual currency. Holding the currency for a year or less implies short-term capital gain taxes, which can be between 10% to 37%. Holding the currency for more than a year, though, implies long-term capital gains, where the tax rates can be between 0% to 20%, depending on total capital that is taxable. Calculation of the holding period is from the day after the cryptocurrency was obtained until the day of disposal, which is an important point. So from the day that you buy it, there are 366 days that you have to wait in order to make it taxed at long-term capital gains, as long-term capital gains. Under currently applicable law, virtual currency is not treated as a currency that could generate foreign currency gain or loss for US federal tax purposes. And capital gains or income in the United States of America. Capital gain tax events involving cryptocurrencies include selling cryptocurrencies for fiat, whichever currency it may be, using cryptocurrency to purchase goods or services, or trading or swapping one crypto asset for another, either on an exchange or directly peer-to-peer. Income tax events include receiving cryptocurrency from an airdrop, any crypto interest earnings from decentralized finance lending, crypto mining income from block rewards and transaction fees, crypto earned from liquidity pools and staking, receiving cryptocurrency as a means of payment for carrying out work, including bug bounties. So when we look at this, what does this all mean? When we're buying goods and services with cryptocurrencies, it can be associated with a lot of overhead work. Even though there is very much tout about going into a store and saying, you want to buy something with crypto, here's my digital wallet, boom, here we go. The paperwork and bureaucracy that can be set off by it can be quite a lot, depending on where you are. In fact, in some jurisdictions, it may be illegal. Getting the tax reporting wrong can result in penalties, which can be extreme. One pays for capital gains, but one does not necessarily have a benefit for capital losses. And some jurisdictions do not consider cryptocurrency as being money. Some jurisdictions, however, which was the case in Australia, consider it equal to their fiat money. And now we need to find out. So my message to you is that you need to find out for yourselves what you have to do in your tax jurisdiction for reporting transactions. It avoids problems, but it possibly also makes it not so easy and not so pleasurable to do. But that's something that each person needs to know for themselves. So after all that, while working through these details and seeing that different jurisdictions can have very different treatments and interpretations of how to treat transactions with cryptocurrencies, I wondered how could EPAM help in this area? And the idea that I had was, what if every transaction that a person made from any crypto wallet using any cryptocurrency was recorded for them in a private ledger containing all relevant information of the transaction required for a given tax jurisdiction that can be used for filling tax returns at the end of the fiscal year. It would simplify tax reporting, avoid tax penalties, and it would make buying goods and services less intimidating and bureaucratic. So now it's time for questions, and hopefully I'll be able to provide some of the answers. So please post your questions to the chat. And Elizabeth, please let me know what's coming through.
Sure. Alexander, could you please enable the chat? It appears like disabled. So in case someone has a question or any doubt, please feel free to post it and I will share it with Edward.
Give it a few minutes while we're waiting, maybe an informal summary of what I found. So basically, just as blockchain is new,
Sure.
so is the legislation that is coming to chase after this.
Oh, I have one.
Okay.
Tax in Belarus
Yes.
and
Oh.
How the taxation of crypto is done in Russia. So maybe you can answer both on the same.
Okay. Belarus, I did not look at. That was not one of the jurisdictions that I chose to look at. I'd be happy to find out. If the person would contact me, my contact details will be on the last slide later. Happy to guide the person in that direction. When it comes to taxation in Russia, because it will not be treated, as an asset, as a currency, it will be treated as an asset. So the normal laws that apply to assets, or the taxation of assets in the Russian Federation, will also apply to cryptocurrency. The Russian Federation does not acknowledge, or is intending to not even allow the use of cryptocurrency for transactional purposes. It will be illegal to do so based on the suggested legislation that is passing the hurdles in the Duma.
If you have any other question, feel free to share it through the Ask and Questions on Community C, and we were able to share it with Edward.
And while we're waiting, I'll continue what I was saying before. So just as the technology is very new, the legislation that is trying to catch up with this technology is even newer. There is no consensus worldwide or as to what should be done or how it should be treated. So every country has a bit of a hodgepodge at the moment. Some are very open to allowing transactions with cryptocurrency. Others are very rigid and tight with that. They do not actually want to allow it. Russia, for example, forbids it. From what I read recently, I think China forbids it as well, or as good as forbids it. Whereas I think it was Uruguay or Paraguay in the last few days actually announced that they will accept it as equivalent to their own legal tender, which is what Australia has said informally. It was the head of the Treasury of Australia that said that it is as legally valid as the Australian dollar in Australia. So there is a broad spectrum of what is available out there in terms of legislation, in terms of restrictions or openness. It's a new field, and countries are trying to catch up and make up their path as they go along in trying to regulate these transactions.
Oh, there's a new question.
Yeah.
Do any jurisdiction allow you to pay your taxes in crypto?
There is one canton in Switzerland, which is called Zug, which is the home of the so-called Crypto Valley, which allows one to pay certain taxes that it has, like Gemeindesteuern, which are municipal taxes and things like that, using Bitcoin. That is one that I know of. I believe Saudi Arabia may also be pretty open to this idea. Or if not Saudi Arabia, then at least one of the Gulf nations, I think, is either considering this or is going along down the path of allowing this as well. At this point, these are the jurisdictions that I know
I don't see any
of.
other question, but let's give them a few minutes more
Yep. Okay.
in case they feel a little bit shy.
But what is interesting also for the example from Australia, for the moment, because it is so new and because it is growing at such an expansive rate, as I mentioned, the amount of details that are required to be reported to the tax office when one makes a transaction with cryptocurrencies is actually a lot more detailed than what's required when one buys or sells shares on the Australian Stock Exchange. Part of the reason for that, amongst other things, is one is actually being asked to be a check and counterbalance to the other side to actually help and make sure that the other side is also reporting what's going on, assuming that they're also within Australia. But to some extent, it's also because because it is so new, and they would rather get too much information than not enough information. So this is really a new field, and jurisdictions are really trying to figure out what they're doing as they're going along. So these may change. It could be that some of this legislation within half a year to a year or 2 years will actually already be outdated and will have been set into very different kind of laws. It may develop over time that there will be some kind of international standards that will be set up. However, when we have some jurisdictions that say, no, we will absolutely not allow any cryptocurrency transactions within the borders, and there are others that say it's equivalent to their own currency, it's a bit difficult to see how this can be managed globally, but maybe there will be pockets of acceptance or alliances, some kind of unions, but we will see. It's an interesting field. It'll be interesting to see how this develops in the next few years.
Edward, we have another question.
Yeah,
Are there
sure.
any work to correlate the crypto taxation across USA?
Sorry, I didn't understand the question. Could you repeat it,
Are
please?
there any work to correlate the crypto taxation across US?
So I'm assuming that the question is asking at the state levels and then at the
Oh,
federal
oh,
level. I was looking
sorry,
only
I
at the
think
federal
it
level.
is
No?
European Union, EU. It is
Within the
not on the
EU.
USA. Yes, on the
Okay,
EU.
sorry. No, as far as I understand at this point, countries are looking at this separately. Given that it's the EU we're talking about, probably eventually there will be some kind of standardization. But at this point, I believe it's pretty much every country for itself at the moment. Although it could very well be that every country is looking at over every other country's shoulder to see what they're doing.
What countries do not calculate taxes?
The question was, what countries do not calculate taxes?
Yes.
In the Western world, I'm not aware of any country that has decided to allow barter transactions to happen within crypto or even exchanging crypto for other crypto without some kind of tax implications. I've seen this used often as an argument as to show, wow, Bitcoin is good, or cryptos are good, and they're here to stay. They're the real thing. That even governments are taking them seriously with taxation. My view on that is that this is an opportunity for taxes to be an opportunity for the tax as another source of income from taxes. This doesn't necessarily mean that later the governments are going to say yes, it has equal parity to their own currency, unless some countries really do say that. That's the case already informally with Australia. But with many other countries, it's simply, if people want to use it, they can, but here's an opportunity for taxation, here's an opportunity for tax income. for the governments. It does not necessarily imply that they see crypto as being an equivalent or as real or as good as their own fiat money. Now, what will be interesting then is when we get fiat cryptocurrency, which the European Union is discussing, I believe China is discussing, and I believe some other countries are also are already discussing. Then it will be a different ball game altogether.
Okay, we have another one.
Sure.
Are there any differences in tokenized stock taxation?
That is a good question. I believe I have not looked into that in detail. That's the first answer. The second answer, though, is that there we're talking about shares in the end. So we have on the one hand crypto, but that's not necessarily there as cryptocurrency. There we're dealing with tokens which are meant to represent shares. So there I would say that the taxation, if the taxation would be different between cryptocurrencies and these tokens, then I would not be surprised. Because I believe that we'd be talking about two different classes of assets. Or
Okay.
two different types of things, depending on the jurisdiction, of course, because in Russia, there will also be assets. So,
Okay.
I mean, for example, as a general rule, I think that we'd be talking about two different things.
Okay, and I have another one.
Mm-hmm.
Why some huge crypto exchanges rejected USA user?
I'm not aware of the details of the background to that question. So if the person could type in some background very quickly, perhaps.
And I think that's all the questions that we got.
Okay. Was there some more detail given to the last question?
I think they're on a topic, but you can talk about more about that, or if someone can share more details about the crypto exchanges rejected, if you can share some examples, maybe.
I didn't understand the question fully. I'm sorry.
It says that why some huge crypto exchanges reject USA users.
Based on my experience of having lived in Switzerland for 20 years and what the US authorities have been doing when it comes to American citizens who have been performing tax evasion in Switzerland. So if I need to assume what might be going on is that maybe some crypto exchanges just do not want to touch American clients because that would mean risking the full wrath of the United States federal government coming down on them if somehow it turns out that the US citizens were trying to use their exchange for tax evasion. There was a time in Switzerland when the banks basically rejected almost all US clients and threw out almost all of them just because having them as a client became more of a risk than it was, so to speak, worth for them. I could imagine that maybe something like that might be going on when it comes to some crypto exchanges, that having US citizens as clients might bring the attention of the US federal government and its offices onto that exchange.
Okay, we have another question.
Yeah.
Is NFT typically subject to the same taxation as a kind of cryptocurrency?
That is again also a good question. I have not looked into that. So if I was to say something, do not have enough information to be able to provide a reasonable answer. I'm sorry, but it's the honest one that I can give. Because the nature of a non-fungible token and the cryptocurrencies, although they're built on similar technology, they have different purposes. And it could be those distinctions or the differences that could make the difference between the tax treatments or even how they're even viewed for tax purposes. But I have not looked into that, so I'm not sure. So I cannot answer at this point.
Uh, it says you told about tax when someone receives profit.
Mhm.
Is any tax return if we lost in crypto value?
That depends on the jurisdiction. For example, in some of the jurisdictions that we looked at, you have to pay, you have to share with the government from your profits when you make a profit, or capital gains rather. But when you have capital losses, then you bear the brunt of it yourself. So it depends on which jurisdiction you're in. Every jurisdiction can decide this differently. And it's not necessarily the case that if you make capital gains of 1 million and capital losses of 500,000, that you're only taxed on 500,000 capital gain. Could be that you're taxed on the full million while having made losses also of 500,000. So it depends on the jurisdiction.
I think that is all for now. We still have a
Okay.
few minutes, so if someone wants to ask something else, and if not, I think that you help a lot of people with their question.
Hopefully.
Okay, so there's no more questions. Thanks a
Okay.
lot to everyone for joining to this very interesting topic set by Edward Rubinsky. Thanks a lot, Edward, for share your knowledge with us.
My
This
great
was
pleasure.
very interesting. Thank you.
Thank you also.